Most investors think they're making progress when they're being active. They rebalance, they tweak, they react. That feels productive. But in investing, activity is one of the least reliable signals of progress. When something feels uncertain, doing something reduces the discomfort that we feel. That's why checking our portfolio frequently feels responsible. Trading actively feels engaged, and adjusting the portfolio feels intelligent. Psychologists call this action bias. In a previous video, I've talked about the goalkeeper study and how professional football players dive 93.7% of the time during a penalty kick, even when staying dead center gives them a better odd of making a save for 1/3 of all the kicks. When they dive, it's about social signaling. Standing in the center and failing while doing nothing seems negligent and will probably aggravate the fan. A study in emergency rooms showed that doctors end up ordering more tests when they feel uncertain or helpless, even when the test or their outcome won't change the treatment for the patient. Those tests are not a medical necessity, but the activity of ordering them was palliative for the doctor's anxiety, not the patient's health. We trade not because the strategy requires it or that it improves the outcome, but the activity feels more responsible than just patience. Here's the key thing to remember. Activity lowers anxiety, not risk. Here's the truth. If progress were obvious while it was happening, fewer people would end up sabotaging it. As high performers, we are especially vulnerable to this professional trap. We call it the illusion of control. It was first discovered by Ellen Langer at Harvard in the 1970s. She found that people often overestimate their ability to influence outcomes, especially when they have only partial control over the process. In most professional careers, we often have significant control. More preparation equals better performance. More effort equates better results. That feedback loop gets deeply internalized into the way we make choices. It's Huxley's law of reversed effort. The harder we try to outsmart the market, the less likely we are to succeed. When you bring that same instinct from your career or your profession into investing, you're met with a situation where markets don't care about preparation. Increased engagement can be counterproductive, but that illusion of control continues to persist because it's so deeply ingrained in us. We often do that knowing that it may not help, but because the opposite of doing nothing feels like surrender. But constant activity becomes an illusion that you can influence or control an activity or an outcome that you actually have no control over. Too much interference actually breaks the system. That's why professionals build rules-based systems. Institutional funds restrict discretionary intervention, and successful strategies end up looking too simple. Decision hygiene ensures that I build a system when I'm calm so that it can run when markets are emotional. Every additional decision that I allow myself to take is just another opportunity for me to be wrong or to allow emotional attachment to override and for activity to disguise itself as progress. Activity drag ends up happening through timing errors, traction costs, emotional fatigue, and structural drift. None of these actions feel very dramatic when they happen in the moment, but that's actually what makes them so dangerous. In a study by Vanguard, where they look at the value that financial advisors add to their clients, they call it the advisor's alpha. The report found the biggest source of value wasn't in selecting the assets or the allocation, but it came through behavioral coaching, supporting clients from making decisions when markets are volatile, essentially protecting investors against themselves. The report estimated that that alone was worth 1.5% in annual gain. The IPS are designed from preventing high-earning fund managers from making the exact same mistakes. The real test is to do the decision audit, to decide between progress or activity. You can do it by running every portfolio decision through these 3 filters. If you can't answer yes to all 3, then you're most likely mistaking activity for progress. The first is the motivation filter. You begin by asking yourself, if the market was closed for the next 30 days and I couldn't see my balance, would this adjustment or position still feel urgent? This essentially strips away the action bias. If that urge disappears when the scoreboard is hidden, your move is driven by anxiety or activity and not by strategy or progress. The second one is the evidence filter. Ask yourself, am I reacting to a loud signal, so changes in news or prices, or am I reacting to structural drift, portfolio weights changing, or rules in your system? This combats the availability heuristic. Progress comes from maintaining the architecture of your portfolio. You're rebalancing because of drift, but activity comes from reacting to market headlines. And finally, the third one is to do the pre-mortem filter. You begin by asking yourself, if I make this move and it fails, will I still be able to explain the logic using my original investing thesis or rules? Or will I have to admit that I was just trying something? This kills the effort justification. It forces you to admit to yourself that you're deviating from your Ulysses contract to justify activity. If the answer is yes to any of these, it doesn't make you a bad investor, it just makes you human. But it also means that you need a system that is designed for humans. This isn't about judgment, it's about creating a filter that sets you up for success. Once you're able to take a step back and see how easily activity can disguise itself as progress, you end up asking for fewer decisions. The goal was never to be a more active investor, it was to be a more effective one. And those two things are almost never the same.